Hey everybody, it's Hutch here, and today we are going to talk about the utility of a lot of the tools on the Terra ecosystem for traditional wealth building goals people have. So for accumulators in accumulation and how you can amplify that, and for retirees who want to, they say going up the mountains hard, going down the mountains harder, for retirees who want to spend their wealth in a world where yield is so hard to find and income is so hard to create without cannibalizing assets, and using some of Terra's native tools and the protocols being built on it to help with that, those centralized finance goals that a lot of us have. And I have an old friend here, a very old friend. I've known him for a long time. He got into crypto so early and tried to get me into it. I just wasn't there yet. It was a really interesting white paper, but I just didn't know if there was going to be adoption. I credit him for getting in so early. He even got lucky and got Luna in the teens and then later in the single digits because he had met a developer in his travels in crypto and became friends with him. So he got in very early. And the way he uses Luna and the Terra ecosystem is very simplistic. And God bless him, he can be, because he's killed it so far. But he is interested in some of these things and realizes that I've been pouring into it and researching it, but maybe just a little concerned, a little scared of the risk, and things are complicated, right, buddy?
Yeah. Hi. I was lucky to get in about 2016. Since then, I've basically been a hodler, but was exposed to Luna here a few months ago and got lucky to buy the dip, shall we say, when it got crushed down into the single digits. I've been intrigued with it, been staking some coins, staking my tokens, but haven't done anything beyond that.
Cool. Let's just talk about staking for those people that are new and don't get it. Staking is a mechanism where if you bought some crypto, in this case Luna, but you can stake Ethereum, you can stake Polkadot, you can stake Solana. It's a way for when you have crypto on a certain blockchain, it's a way that you help validate the network. And so you can actually run a node, you can set up a computer to run a node yourself. A lot of people don't want that responsibility. I don't. So you can delegate your cryptocurrency with certain validators and people that have infrastructure, and you can look at them and see what their uptime is and see what their record is, and you can pool your tokens with them, still have ownership of it via smart contract, but they are essentially validating the network. And because of the word stake, essentially it's not mining or proof of work like Bitcoin where they have to solve complex computations. Really, all the validators need to kind of post up more coin than they stand to make. So if they're a bad actor, they just get their coin ganked. And so it stops any moral hazards when the validators are posting more coins. And so these validators want us to stake with them because the more coins they have to be able to validate, the more rewards they can earn. And they take a small commission off the earnings and they share with us. I believe currently within the Terra Station, in fact, let me just share my screen real quick. Currently on the Terra Station, if we go to the dashboard, we can see the staking return, from Genesis. If we look at the last 30 days, it used to be in the 4s and 5s and has ramped up considerably, come down a little bit, probably because so much new money has come into the ecosystem with the pump, but pretty attractive yields to help stake on the network, right?
Well, it's more than attractive, really, when you consider what you get on a 10-year treasury.
Right. Well, and I've been saying this a long time. This is actually what hooked me into crypto, is in a world, and I'm an ex-financial planner. And so really everybody's been forced into a model where yield's essentially gone. Everybody's been kind of forced back into a model to get into equities and take risks, meaning like buy low, sell high. And then when you sell high, you cannibalize your assets to live off that income because there's not a lot of yield out there. And when I realized the other thing about yield is it's almost always debt, always. And when I looked at DeFi and I said, wait a second, these are attractive yields and it's not debt-based. There is a way to make money from lending, but when you have a way to earn yield and it's value-based, you're validating these networks that more and more people are going to start to use. I said, wait a second, I got to get into this. I got to learn more about this. So here I am. But let's talk about some of the entry level positions that I think people will be most attracted to. And I'm going to pull up on my screen one more time. This is Anchor Protocol. It's one of the keystone protocols on Terra Luna, and it's UST is a stable coin. So it's crypto that really acts like a money market. It's trying to always be $1 worth of UST. Well, more and more people are coming in to buy UST largely because of this. And I think of, people call them normies or whatever, noobs, normies, whatever. They don't want to take a lot of risks. They don't want to research crypto. Sure, they'd love to buy low, sell high, but most of the stuff, crypto in general, is going to turn to fairy dust without the use cases. And so like I asked my friend here, like, what would your mom be most interested? Well, 19.5% on a stable coin is pretty attractive, right? You think she'd be into that?
Well, she would be into it. The first question she'd have, though, is, where does that come from? Which, I think anybody is going to have that as a top question, because, they're just not going to believe that it's possible. So, but they're operating under under a paradigm, that's old school.
Yeah, and let's face it, there's other risks that we can talk about, but where it's coming from in this case, there's a borrow tab, right? And this is my anchor, and I actually am borrowing. So I don't have money in UST. I don't keep a lot of money in UST. It's still my paradigm. I'm an accumulator. I have money coming in. So I've been buying mostly Luna, and you can park your Luna, you can bond it and park it as collateral to borrow against it to do other things that we're going to talk about later in this video, other income generating opportunities on the Terra ecosystem, or you could do it to buy more Luna itself, or you could do it to buy other altcoins. And so that's what I've been doing. And you can see currently there's a net APR of negative 1.38. Now the borrow APR is 24.51. So the 19 is definitely coming from here. It's coming from here. The other place is coming from, what did I say in order to borrow that I needed to park? I needed to park Luna. Well, we talked about it before. That earns 9% right there. So how is it sustainable? It's sustainable because they're charging borrowers 24.5%. So there's a 5% spread that they're keeping because they're paying 19.5, plus the extra 9 they're keeping from the bonded Luna that I'm posting, and I'm no longer earning that yield. Now, this is where I think people on the borrowing side get a little like their radar goes up, their BS meter goes up, because to incentivize me to borrow, because let's face it, this is not the most attractive borrow rate in the world. To incentivize me to borrow, they're going to pay me 23% simultaneously. Hence, the difference is my net APR. They're going to pay me an anchor token. And there's been times, even as early as yesterday, this was slight positive. It kind of fluctuates depending on how many people are borrowing, how many people, whatever, because they want to incentivize a certain amount of borrowers, but they're paying me in the anchor token, which is the native governance token for this protocol. And what's your first question, friend? Like, I know all alarm bells are ringing. What are you thinking?
Where does that come from?
Yeah, where does it come from? It's a great question.
Where does the 23.12% payout in anchor token come from, and is that sustainable?
Those are the exact two questions I figured you asked, and let's address them in my very simplistic view. And I do plan to do a detailed write-up and thread on Anchor Protocol. Once I do, it'll be in the description. But for now, this is what I came to an epiphany on a plane over Thanksgiving, and I realized that if you're a new company, there's all kinds of new companies. Forget crypto, just new company, Uber, whatever. Like there's a new company. Like there's new lending companies I know coming out in Silicon Valley. What do they have? They have early investors, correct? Usually VC money, venture capital, early investors. And what do they usually do? They usually just kind of give away tons of shares for pennies on the dollar?
Of course, that's the model.
That's the model. So I thought about it. I thought, you know, in order to attract people to UST, which will raise the price of Luna because you have to burn $1 of Luna, you have to get people minting UST. This will get them excited to mint UST and keep UST on here for a long time, not to mention all the different things you can do on it. There's even debit cards and gift cards and now that you can use to go ahead and spend your UST. But to get people onto the system, they need to have some bait. And this is pretty good bait. This is pretty attractive bait. And in order to support this bait, they need to get people borrowing. But people aren't going to just, I'm not going to rush headlong into borrowing at 24%. And no, I don't think it's sustainable in its current form. But unlike having a bunch of VCs, aren't they really just incentivizing usage of the platform to support the good yield for depositors?
Yeah, that's a really good point.
Yeah. So
and that'll probably and that'll adjust given some time to something maybe a bit more reasonable when the perceived risk is is lower.
Yeah, no question it will, and it has. I mean, these APRs used to be like positive double digits, and that's when I started learning about it. And I was like, "Hey, what? That sounds too good to be true." But so many people are talking about it. I got to learn about it. So since I've got into borrowing on Anchor, I've seen it plus or minus, call it 2% and change on one side of the fence or the other. Now it can adjust, but I'll tell you what, even when it was negative 2.5, it was still pretty attractive for me to go ahead and borrow to do other things with, which you'll see. You'll see the income opportunities later in this video are pretty attractive. But for now, and it won't last forever, but for now, to basically give away the governance tokens, right, or shares of stock in the company, whatever you want to call it, they could give it to a bunch of VC investors and hope they do good marketing or good advertising. But some of the best marketers are people like me on Twitter who are just using it, loving it, and raving fans posting about it. And we're telling our friends, we're telling people on Twitter, they're telling their friends. And what do you know? Luna's been going like this. UST minting has been going like this. And that's why Luna's been going like this, because more and more Luna's getting burned to mint all this UST.
And everybody should like that because that's a much more democratic process.
It is. And that's one of the things I love about DeFi. So now that we understand the basics, let's move on to something a little more complicated. And this was another staple protocol called Mirror, right? And I'm going to go straight to trade. So Do Kwon and Terraform Labs made Mirror. And this is one of the stories, again, fulfilling on Satoshi's vision of helping the unbanked. You know, you and I could go to an American stock exchange, find free commissions, low spreads, whatever you want to call it, and get into any of these stocks. And this is Mirror Token. This is the native, but Apple, Airbnb, AMD, Amazon, ARK, Alibaba. Well, that's Bitcoin. Coinbase, Polkadot, that's crypto. Facebook, right? Google. So Hood, all these things. So none of this is investment advice. Everybody has to do their own research. But at any time, we could go and get these. But Doe made these so that the unbanked would have access. I was on a Twitter Spaces the other day, and there was a gentleman in the Philippines talking about gaming. There was a gentleman in Nigeria talking about the rise and the popularity of Luna and how he wanted to learn how to do everything, and he didn't want to sell any of his Luna, and he was bullish. And you know, it's not easy for people like that, first of all, to even afford, let's just say 5 shares or 3 shares of Alibaba. I was looking for Netflix here. Netflix is expensive. $600 of UST of worth of US dollar. It's not easy. Well, now it's $5.99, but it's not easy for them to get that. And then, first of all, to even find an exchange that'll accept them, get fiat on there, all the KYC, and now there's an on-ramp to American equities that people understand. And there is a premium. So you can see there is a 5.49%. This is a premium if we look up here. So you and I may not do this to pay a 3.3% premium for Apple, but a lot of people do want exposure to Apple, and this is worth it to cut all those corners or to be able to take a very small amount of money and get fractional shares. Agreed?
Well, I absolutely agree. And if you look at that the 3.3, that's not so much higher than a lot of people still today paying a commission to a full service broker.
Absolutely. Yeah. It may even be less. And, there's spreads, there's even just regular commissions, or even when there's no commission, somebody's paying for order flow, right? Like even the big one, Schwab, not just Robinhood, has been accused of paying for order flow. And you never know what's going on with these market makers, right? Where they're routing the orders, right. And are they going to the best market makers? And that brings us to another point. So I don't know how many people know what a market maker is, but there's an opportunity for you on the Terra ecosystem to be a market maker or to participate in being a market maker. So a market maker, take on the New York Stock Exchange or NASDAQ or whatever you want to call it. They're a bunch of guys out in New York City. They had to go to Ivy League schools. They had to go work for a company like Goldman Sachs or JP Morgan or whatever. So very privileged opportunity for the few. And they make a lot of money. And how they make a lot of money is, I call it, it's kind of like a bookie. And people don't like to liken gambling to investing, but there are a lot of corollaries, needless to say. But what they do is they say post a price of Apple. Let's see what the price was. So 160, right? They'll post a price of Apple and they'll say Apple's 160. If you want to buy it, give me 160 and a nickel. If you want to sell it, it's 159.95. And all these guys do, they don't care which side, they can't choose which side they take more of. If people load up on one side, they have to go find a way to hedge off their risk, because like a bookie, they're trying to balance the books. If they say they'll take the Rams -7, right? Or they post the Rams -7, they take both sides. They don't really want to bet on one side or the other. They'd love a perfectly balanced book and to collect the 10% from the losers who pay more. Same thing with the market maker. They want to collect that spread all day. That's all they want to do. They want to stay delta neutral, is what it's called. Meaning if they end up with more people selling than buying, what they'll do is they'll go ahead and they'll sell calls or buy puts, right? To balance their book so that they have the exact same delta as being even. So then they just collected the spreads. They don't want to take a directional position. That's what delta is. It's one of the option Greeks for a position. You want to be delta neutral and just collect the spread. There's an opportunity for you to do the same thing on Mirror Protocol. And you asked me earlier, why would you do this?
Right. If you go, and even with less risk, you could just stake Luna for 9.5. So why would you go to?
Well, first let's talk about that. First of all, it's not less risk in that Luna's price has and will fluctuate. It's great right now. It's pushing 70 and it's going up. But I mean, let's face it. You originally bought Luna in the teens, 15 or 14 or so, and it fell to 5, right?
Right.
And
well, let me just take the con for that for a moment. My position on Luna is that I always take a very long-term position, long-term thinking in this. I'm not like a lot of people. I'm a hodler. So I believe that Luna is going up and it's going up big. So when I say no risk, I'm talking about, over a longer period of time, not, in the short term.
And I agree with you. I just didn't want to give our listeners the impression that they can just buy Luna and earn 9% for perpetuity and not have any volatility.
You would be right. Correct. That's correct. Yeah.
I'm in the same boat. In fact, I put in some limit orders today, even though I got in later than you, but I got in the early 30s, and then it went up to 35 and I bought some more, and then it fell to the mid 20s and I bought some more. Probably I should have got a lot more, of course. And then it went back up and I bought it all the way up into the low 50s, and then it fell back down to 35s and I got some more, and now it shot back up, and I was like, oh man, I probably got enough Luna. No, I don't. So I have some limit orders in right now in the mid 60s, and hoping it just kind of retraces a little bit before we continue this rocket ship ride. But yeah, I agree with you, hodler. There's that great the hodl, the original saying of how that came up. I'll actually put a link. There's a great video about how that came up. But he basically just said he's not good enough to be a trader. It was a drunken rant. He's not. It was brilliant. It was a drunken rant, but it was brilliant. He said, I'm not good enough to beat these traders.
Games.
What's that?
Said, I'm not into zero-sum games, but that's another story. Go ahead.
Yeah, no, he said, I'm not good enough to beat these traders, and I'm not even going to try. So how I beat them is I just hold. If I just hold, they can't hurt me. And he's right.
Yeah.
So I'm with you on that. But yes, you can earn a staking reward with Luna, but it's going to go up and down. If you park UST, let's just go back to UST.
So anyway, that was my objection. Why do I want to go to this trouble? And I didn't understand until you and I talked a little bit more about it, what the opportunity is income-wise for providing these liquidity pools on Mirror.
Yeah, and so let's talk about that. Liquidity pool is what I was talking about by being a market maker. And now, first, let's just look at Anchor, because this is your opportunity cost. Because let's face it, there's still risk. There's smart contract risk. There's depegging risk. There's actually insurance you can get for both of those. It's going to be in the resources below, because maybe if you just got 8 or 9% or 11%, you'd be thrilled. So you can even insure against the two risks that still exist for Anchor protocol: depegging of the dollar, like breaking the buck. Like in the last crash, it did break the buck, and they've been doing things with the algorithm. And actually, I've heard that they're going to buy like $1 billion of Bitcoin for reserves to make sure that the buck isn't broken. But assuming it is, you can insure against it. And then there's smart contract risk, that if somebody breaks the smart contract and steals your money, you can insure against that. Because I think these are two concerns that people have. Outside of those two major kind of, long tail risks that are real, your opportunity cost is 19%. Like, that's your baseline. Like, why would I even screw with anything if I could just get 19.5% per year? Here's why. If I click the farm tab on Mirror, what you can see is, let's look at, and these fluctuate. Let's just use Netflix. Long farm and short farm. Let's talk about a farm. Liquidity pools are also known as yield farms. And that's just being a market maker. So in order to be a market maker, you can take either side of this. Now, most people would say, well, I'll take the short farm. But that's kind of scary, because if you're bullish on Netflix and you take the short farm, meaning you'll make more money that goes down when it goes down, but you could lose more money when it goes up. That's kind of scary. And so delta neutral, to be like a market maker, you would take both sides of this. You would take equal parts of the long farm and equal parts of the short farm. And what you can see is, if you long farm, meaning you provide the liquidity, and what that means, a little confusing, but you provide equal parts. Like, let's just use $1,000 unit as our base. So we would provide $1,000 of long Netflix and $1,000 of UST, because when people are trading these, they want liquidity. They're either paying you UST to buy your Netflix, or they're selling their Netflix to you to get liquidity and get their UST back. So in order to be a farmer or a market maker, you have to provide equal amounts of both. So $2,000 into this long farm is going to earn you 23.76%. Well, that's more than 19.5%. And last time I checked, more is still more. Until they figure out how to tax us 101%. More is still more. But I know, what are you probably thinking? For 23%, what are you thinking, friend?
I'll take it.
Okay, well, that's good. I was thinking something you told me earlier. It's probably just because you understand it better now, because we talked about it. What you said earlier is it's too complicated, right?
Right. Yeah.
Like,
yeah, exactly.
I'm just going to park my $2,000 in UST and make 19.5. I don't need all this craziness of, 1,000 UST and putting in along. That's just complicated. So the good news is, and you're welcome to continue watching this, because we have more strategies and there's chapters below you can click. But one of the protocols is going to optimize and automate all this for you, which is nice. So now that you understand what's going on, you could say, wait a second, I could have no risk by taking equal parts the long side and the short side of Netflix, so that if it goes down, I lose on the long side, but I win on the short side. If it goes up, I lose on the short side, I win on the long side. And everybody that's trading it, I get my pro rata share of their fees. That's pretty cool. I like that. And I kind of understand that. And I didn't go to an Ivy League school, and I didn't work at Goldman Sachs, but I'd sure like to participate in that. I just don't want to manage it. You're going to be able to, I believe it's Nexus Protocol who's coming out with it. in their V2, the automated delta neutral strategy, which to me is kind of the gateway drug of the whole Terra ecosystem. And why I say that is, I mean, this is like a no-brainer. But then when you want to kick up your yield, it's like, okay, I can earn 23 on the long side. That's 4% more. I can earn 48% more than 19% on the short side. Last time I checked, more is still more. Now I'm interested in that. And so people call these degen strategies. I call this the gateway drug to the degen strategies. The other reason why it is on the short side only, and this is complicated and specific. And I'm going to post some videos by Terabytes and DankUR. They're two other YouTube channels on Terra ecosystem. These guys are great, came way before me, and they know their stuff. They have very detailed videos for people that like to tinker and want to do it themselves. Check out these videos. They're in the description, and they have very extensive videos on how to actually set this up for yourself if you don't want to wait for the automated. But at any rate, what I was going to say is on the short side, you can actually park your money in Anchor and use that as collateral, still earn the 19%, and do this. Because just like when you short a stock, you're always borrowing the stock. What you're doing is you're borrowing it from somebody that owns the stock. You don't own it. You borrow from them and you sell the stock short. And then you have to repay the stock. But if you believe it's going to go down, when you've pre-sold the stock short, and then when it goes down to a lower price, you buy it at a lower price to pay what you sold up here, and that's how you make money. Now with this, we're adding the additional layer of you're earning market maker fees the whole time. So you're not going to get dollar for dollar on the shorts. You're not going to get dollar for dollar on the longs. You're going to have exposure to each. But since they both balance each other out, it's more about the fees. But the fact that you can do this, and if I just click this, you can see choose a collateral asset, right? What we have to post to go short Netflix, we can do UST, or we can do AUST. And when we do AUST, all that is like a depository certificate. We have our money still earning UST on Anchor, the 19%, and we're just using this as collateral to sell the Netflix short to put it in the farm. That was a lot. What do you think about that, or what questions do you have?
I think that's really interesting. The question that comes to mind, I see risk involved in. Is there any liquidity risk here? Meaning that if, for instance, I needed to access my AUST because of some situation going on Anchor that I needed to address, is that going to be locked up in the mirror protocol on the farming side, and is that going to be a problem for me?
It's a great question. So the answer is yes and no. It's mostly no, but the reason why I say yes is because that collateral that you're parking actually gets returned to you in about 2 weeks. But in 2 weeks, if you wanted to close the position, you could do it, and there's a mint fee of right here. You see this 1.5% of the minted value will be levied when the short position is closed. So if you need to absolutely cash out early, you can cash out and lose about 1.5%. But again, if this was like an emergency, that's a small price to pay. It's almost like the same thing. It's like people have their emergency fund, but if something happened when their emergency fund was gone, they'd sell stock and pay a commission on the way out and do a wire transfer or whatever because they need emergency funds. So yes, there's a little penalty, but it's not super penal.
That's only about a week's worth of. That's only about a week's worth of interest on this If you look at the Netflix example you were using, that's about 45% per year. So that's only about a week's worth of interest.
There you go. Yeah, and that's yeah. So the other risk is only on the short side. They recommend that you post 200% collateral, because you can see when you get below 150, your position gets liquidated, right? So in this case, this is short. So if Netflix shot up and your collateral, your AUST collateral started going down, you would need to watch it. And so like there's all kinds of alert systems that you could put up to watch it so that if Netflix started to go up, you could post more collateral, you can close the position early. Because remember, you're delta neutral. But what you don't want to do is get liquidated here because you are delta neutral. But if you get liquidated, now all of a sudden you're straight up long Netflix. And we want to remain delta neutral. So you need to be prepared in very extreme bullish cases to post more collateral. This is not the case on the long side. If things go down, this short position is going to kill it, right? But we don't do this with borrowed assets. You actually have to use UST. That's why you can't double clutch with the 19% here. Does that make sense?
So you're saying you cannot use AUST on the long side?
That's right.
As collateral? That's
right.
Okay.
Yeah, so the way it works with our $1,000 example, you would provide 1,000 UST, 1,000 UST worth of Netflix that you buy UST, you can't have it earning interest, and the 1,000 UST that you provide here, you're not earning 19%, you're earning 23, which is fine, right? Over here on the short side, you're technically posting 1,000 UST and 1,000 UST to do the short, but you can do this with AUST. So that whole thing is still earning interest. Does that make sense? And again, check out ThankYouR and Terabytes Pod's videos. They have great detailed videos. You probably want to watch them both. Just repetition is key. And plus, there's just slightly different perspectives on each one. I know I learned a lot from watching both. And there's also an article that I'm going to post below too. So at any rate, again, going back to this being the gateway drug, as far as your risk tolerance goes, because I know you're a very risk-averse person, and you can be. You don't need to take a lot of risk, but you'd like to earn more income and more yield, so you don't need to sell Satoshis for income, right? You'd love to continue hodling all your Bitcoin, correct? Right? And have, huh?
I won't sell any Satoshis.
Well, if you ran out of other assets, you'd have to, but I think
okay, that would be correct, yes.
But that's part of the reason Luna is going to be your workhorse, and that's part of the reason why you were interested in talking with me.
That's why I bought Luna to begin with. When I knew that there was, because of my developer buddy, I knew that there was going to be a huge opportunity to earn income in a variety of ways, and that's the exact reason why I went into it heavy.
Well, me too, and I hope you're to this point because I know I'm into this point. There was a time where I sold some Luna, and I since regret it. But I feel now about my Luna like you feel about your Satoshis, like especially knowing that I can get liquidity anytime by borrowing against my Luna, sure, by simply clicking borrow and managing this. And I'm going to show you a way to manage the borrow against Luna in just a second. But now that I know how I do this, like I don't ever want to sell any Luna. Do you?
No, absolutely not. Bitcoin and Luna are the only two assets that I would not consider liquidating for any reason at this point.
And I know you have some other.
They both have hard caps, and Luna's capped at 1 billion tokens that were initially created, and there's no more coming. So they hold similar properties, and they're my two top picks.
Well, and I know you have some shit coins that you can liquidate, that you still made a profit on, that you can liquidate and sell. But if you could get Luna and the whole Terra ecosystem as a whole being your workhorse, where you don't have to sell the Luna, you can generate UST that provides a yield over and above borrowing in a manner that's safe, that not only can manicure and self-maintain your loan, but also create additional income. Isn't that a better retirement model?
Oh, it's fantastic. There's nothing else. There's nothing else like it. It's really amazing. So,
well, let me show you the next level. So, Spectrum Protocol is just one protocol on the Terra ecosystem, and they're all about auto compound. So, what you can see is, they have a lot of the same M assets that are on Mirror, and they are the same, right? They're not competing with Mirror, But what they're doing is they're managing it for you as far as the auto compounding, because the way you earn that yield on Mirror is they pay you in Mirror tokens. Now, you may or may not want to keep Mirror tokens for a long time. It is one of the staple cornerstone protocols of the Terra ecosystem, so you may. But what you could do, and what a lot of people do with the farms, just like a farmer with their crops, is they sell their crops. And so what Spectrum does is they auto compound these crops. So let's find our Netflix. So remember how Netflix was paying, it says 26 on the, I think that's a little bit more. They haven't updated this.
It was 23 and 45.
Yeah.
23 something and 45.
See this little red line and see what they're paying if you do your long farm on Spectrum? Did this just get a little bit sweeter?
Well, so how are they generating that? Are they generating that through just efficiencies?
Yes, they're through auto compounding. So see here, when you go to choose it, like I don't have any. So if I don't have any. So if I like, let's just say the 6 UST I have, it's not going to let me because I don't have any Netflix yet. So I can just click here to buy or borrow Netflix to farm with. When I click it, it's just going to take me right back to Mirror Protocol. So it's just, it's an overlay onto protocol. But once you do it and you choose it, you can auto stake it, which means you're going to keep your Mirror Protocol rewards, right? And they're going to throw in a little spec token too. Or you can auto compound, meaning when you earn your Mirror tokens, normally yourself, you would, if you wanted to just increase your exposure to the delta neutral long short Netflix, you would have to take your Mirror, sell it all for UST, and then take half of that UST and buy more Netflix, and then do all the clicks and the transactions to put it on here. You don't have to do that, right? You can just click auto compound, do it, and as you're earning your farming yields, your crops in Mirror, plus a little spec, they're just auto compounding it for you. So it gives you a breakdown here. This is from Mirror, right? Kicks up to this, right? Plus a spec reward. Voila, here you go.
Sweet.
Yeah. And you can do that with a number of them. So I want to talk a little bit about, we're going to go full degen here for a second. So here's some other popular Pylon protocol, mine. Their token's been hammered lately, but a lot of people are very bullish because of things they have building on the protocol. And so if you farm, mine, and UST, if you do it on Pylon protocol, you're going to get 96. You can get 164 here. Anchor protocol we talked about, it used to be down to the 40s because this is one of like kind of the most stable, least volatile protocols there are, right? But I guess a big liquidity provider left. And so just like free markets, they're trying to incentivize people to provide liquidity. More people leave the pool. That means the rewards, the fees of people using Anchor, right? Because every time you go to borrow, you have to pay a quarter. Every time you go to deposit money to earn your 19%, you got to pay a quarter. Depending on how much you borrow, there's another fee between a quarter to $1.60. But lots of people are doing it lots of times. And like when Luna's pumping and my LTV is going down, I'm like, oh, I could borrow a little bit more. I'll slide. And so every couple of days I've been going on there and paying these fees. Well, when liquidity leaves the market, they want to incentivize farmers. We need avocados, make avocados, or whatever it is. It kicked up to just over 100%. Now it's a little bit under, but if you do it on Spectrum and have them auto compound it for you, you're up to 167. Let's find some more. This is kind of an interesting one. I know you're into gold too. Before you got into Bitcoin, you were into physical gold. And IAU, and I know you're not a big fan of paper gold, but IAU is one of the most liquid ETFs. So this is a way you can get exposure to gold. You can also long short farm gold. You can see the APR isn't as high, but you use the auto compounder and it's 23.1. And if we go down here to find the short farm, where did it go? Here, I'll just do Control F.
I think you got silver. I think you can do the same thing with silver on this.
You can. So look, you can short farm it at 36. You can long farm it at 23. And now you're not it doesn't matter, you're delta neutral anyway, but you're kind of diversifying your pools. And the reason why that's important is because of something you brought up anyway. What if you need to stay liquid? So when I look at laddering different liquidity pools, different yield farms, because if I'm borrowing on Anchor, and let's say that the price of Luna drops from this high, and all of a sudden my LTV goes, uh-oh, well, when it gets to here, when it gets to 60, they're going to liquidate my Luna from 60 all the way back to here. And I don't want them selling any of my Luna. We discussed that. And so I'm going to be posting more collateral. I can always post more B Luna if I have it. And that'll give me a little bit loan to value, but they don't give me full loan to value on my Luna. They don't give me 100% LTV. But what are these liquidity pools? What are all of them that I've showed made of? They're half what? They're half, what's this?
UST.
And I could use the UST to click repay and manage my loan dollar for dollar right there in the event of liquidation. So I like to have different tranches of liquidity pools. If you like this idea of borrowing or you want to explore more, there's a guy on Twitter named Lunanomics. He's a freaking genius. Gosh, the guy's a genius. Follow him on Twitter. But he has this whole doc of pinned tweets that is just a masterpiece. And it's basically how he turned a matchstick into a lumber yard by using leverage. And he used it pretty aggressively, but he was so shrewd in how he did it. But what he talked about, and he has one tweet all about risk management, what he talked about was when you're managing your risk, you post whatever Luna you can, right? But remember, when you post it, you lose a yield. So maybe what you want to do first is he brings this up in kind of his hierarchy is you sell your strongest pairs first, your strongest farms first. You sell those. And the delta neutral ones are going to be pretty strong. And so you could take that UST and you could throw it onto, you could throw it on there. And so this one's not yielding as much, right? And say your Netflix, you're delta neutral, but your Netflix is still yielding a lot because there's a lot of volatility. Maybe you don't want to throw that one overboard yet. Maybe you want to throw the gold one or the silver one first. That's just one idea. I was trying to get to the degen though. I digress. Hopefully that was a good digression though. So here's one I was involved in, and it was volatile. So PSI, it was the new darling. And this is the one that's going to come out with the, hopefully the automated delta neutral. That's the thing. When you just own it and you stake it, you're going to better participate in a parabolic move. When you put it in a farm, yes, if it goes up, the value of your whole pool goes up, your liquidity pool goes up, but you're not going to necessarily get dollar for dollar growth. And that's, they call it, I don't even know why they put the word loss, but they call it impermanent loss. It's not a loss. It's almost like an opportunity cost loss, or they should call it, yeah, something like that. But it's basically saying it's an impermanent loss because you wouldn't have made as much as if you just held the token yourself. The Ryan Lyon, another great Luna influencer on Twitter. There's a pinned tweet, or there's a tweet by him that really explains impermanent loss well, but I hate that word loss. He didn't make it up, but he does explain it well. But at any rate, PSI fell all the way back down to 7.9 cents. Luna was dumping. And so I had to sell some of my PSI back in the 20s just to manage my loan because I kind of over leveraged, and I recommend you guys don't over leverage. And I was doing all this kind of degen stuff instead of some of the safe stuff, which is actually probably the best thing that happened to me. It got me interested in like, what are some safe ways to do this? So I can have some tranches or some ladders. But PSI, the farm now, it's gone up to like 11 or 12 cents, the token. So like I actually bought some more, and I was doing some liquid staking on there to where it kicked off some PSI token, and I just kept it and stake it. You know, going from 8 cents to 11 cents isn't too bad. But at some point when it stabilizes, I'd like to get back into this liquidity pool. If I do it right on Nexus, it's this. If I auto compound it, it's this. Beware though of big numbers. And again, none of this is investment advice. Everybody has to do their own research. This Valkyrie pool was up to like 3,000 something. And I almost got some just because of the number. But you have to, I feel like, because you're not delta neutral in this. Unlike the delta neutral where you have the long side and the short side, you're simply long farming this. So if you're not bullish the project, if your liquidity pool goes down, you always have equal parts UST and PSI. So if the value of the token goes down, so too is the value of your token. Now, if you're farming it, you won't lose as much. So I told you I had some farms of this. I started a farm in one of my other videos where I talk about, it's called my Luna Anchor Nexus Twist, where I talk about beginning to end. You buy Luna, you park Luna, you borrow against Luna. We actually bought some more Luna, and then we borrowed a little bit more to do a PSI farm to pay the loan down. So there's a link to that video down in the chat. It's, if you're new, it's a good way to kind of really wrap your head around this degen stuff. It's kind of the most simplistic and pretty conservative the way that I did it in there. But that example, we did $20 and $20. And remember, I think PSI coin at the time was 30. So PSI went from 30 to 10 all the way down to 8, but it lost 2/3 of its value. My pool went from like $20 to like $12.50. So I didn't lose as much in the pool because, and I was earning fees that I didn't even add back to that. So you don't lose as much in the pool. So again, when things go up, you don't make as much because of impermanent loss, but when you lose and the pool goes down, you actually don't lose as much either, which is nice. Going back to Valkyrie, almost got into it just for the number. I said, you know, I have to believe in the project because you have to believe the thing's going to go up. I read it and I didn't totally understand it. It was about marketing. I know a thing or two about marketing, but it was like almost like a weird kind of pay to play marketing. And I didn't feel like doing any more research. And so I just thought, you know, this seems a little fluffy to me. And sure enough, now it's paying zero. I don't even know what it's at now. It's not zero. It's greater than zero, but it's obviously fallen from grace quite a bit. Questions about the degen stuff or thoughts about these kind of smaller cap, higher yielding opportunities?
Well, for a conservative investor such as I consider myself, I mean, I'm conservative for a crypto guy.
Yeah.
I would probably avoid them for a while, just because of my risk tolerance. I'd probably be more amenable to definitely more amenable to Anchor and the mirror. Now that I understand the mirror delta neutral strategy, I think that's really interesting. And I think these are interesting. I just, from my perspective as a conservative investor, I think we need a bit more time before I would be willing to, jump in on these things.
It's totally fair. It's totally valid. And another thing that you can do, and I know what certain protocols are doing, is they're doing it to where you put your safe stuff, say like the delta neutral, and you take some of the yield from that, or you park it in Anchor and earn 19%. You think like, anything over 1%, I'm playing with house money anyway. Right?
Exactly. Okay.
And so you park some money in Anchor, and then maybe you want to keep 5 or 10 or whatever. Just split it down the middle and say, I'm going to keep half my yield and I'm happy. But the other half, maybe I'll take the other half of that yield and accumulate it for a little while. And then I'll pair that and I'll take a shot with one of these things as I'm playing with house money. That's another way that you can look at it.
Right. That makes sense. And then do whatever you want with the proceeds of that. Maybe buy more Luna or live on it or whatever. That makes sense.
Yeah, and you don't even have to incur any loans. I wanted to bring one more. This is another semi-conservative one, so I think you'll like this. But I want to bring it up, and it's kind of similar. It's almost kind of like pseudo staking or synthetic staking. So the benefit of staking, there's a couple main benefits. So the benefit to you is you earn a nice yield. The other benefit that you don't see here is you get airdrops. So all these different protocols that we've talked about, remember we talked about like VCs and all that? Well, what they do, a lot of these new protocols, and even some of the old ones, is anybody who stakes Luna, who chooses a validator, so you go here, you choose a validator, anybody who stakes Luna, not only do they earn that yield, but they'll also get free airdrops to some of these protocols over and above the yield. And airdrops are just like, you'll kind of get free tokens. It'll say, claim your airdrop, and you click yes. And it's like, wow, that's cool. But one of the negatives is if I go stake Luna on here right now, and going back to if you need some money, it takes 20. What's that?
It's locked.
It's locked for 21 days. So if you go to undelegate from one of the validators of the network, it's going to take 21 days to actually get your Luna back to use it for anything. And for those of us still kind of building a stack and we don't just have money that we can kind of set and forget and put away, that wasn't very appealing to me. So remember we talked about liquidity pools. You guys all know what this is now. This is a different dashboard, alpac.4. You would actually do it on terraswap.io. So I'll just go to terraswap.io. And when we go to terraswap.io, let's click the web app. Wow, I sounded like Elmer Fudd there for a second. Elmer Fudd, that's a joke because we talk about FUD all the time. That's funny. I'm going to call people that when I'm going to call them Elmer Fudd when they're fudding. All right. So, so see swap and provide. I can provide liquidity for the Luna B Luna pool. So B Luna tracks the price of Luna almost exactly. So look, if we put this here, I have 0.63 of a Luna that's just sitting there. I like to keep a little bit for fees. Notice it produces 0.641. So I get a little bit of extra Luna, but in the form of B Luna, because you need B Luna to park as collateral on the Acre network. So a lot of us are using B Luna. And so what you can do is you can actually provide liquidity instead of swap if you had some of each. And by doing so, this alpac4.com, it's going to be in the chat. It gives you a running total of what that's paying. So it's paying a little bit more than traditional staking right now, but it's been less. It's been a lot more. Depends on how much liquidity is being provided, how much Luna B Luna is being traded. It's dynamic. But what I like about this is just like any other pool, I can just simply, once I have it there, and I had to do it the other day when Luna double bottomed at about 38, 39. And I was like, oh crap, here we go. We're going back down to like the mid 30s, the low 30s. I don't want to get liquidated. I had to kind of withdraw some of it. Right? I had to withdraw some of it, and a few clicks, right? 30 cents, and we're there. And so it's almost like you're not staking, you're doing a liquidity pool, you're farming, but you don't have to worry about impermanent loss. You do have to worry about loss of Luna, but if you're bullish Luna anyway, and you're a hodler like we talked about, there's no extra risk here. Like, because the value of Luna is the value of Luna. B Luna is a little bit different, but like, it's not that much different. So this is another way you can quasi-liquid stake. Does that make sense?
Yeah. Okay.
Also, since we're talking about liquid staking, we talked about Nexus Protocol, the PSI token. Cool. It's up to 12.122. About where, getting close to where I got it in the first time. So you can farm it, and we saw on Spectrum you can get a little bit more, 142. If you own it, you can go to the vault, or no, I'm sorry, to govern, and you can see I got some stuff staked here, right? And again, I'm going to wait. I want that upside potential. From the bottom, I've already made 50% off the bottom. I was holding it. I was the loss, but I would have sold at the bottom, like I saw a lot of Elmer Fudds doing on Twitter with Nexus Protocol. I wouldn't have experienced this 50% loss gain over the last week. But if I go to Vault, I can park B Luna here. And again, this is liquid, and you can see I have some B Luna here. Only because I don't make as much as the swap, but I didn't have 98 additional Luna to pair with it. And so and plus I thought with PSI being so low, I've earned 31 PSI tokens. I was cool with just earning 7% in a depressed value token. You don't earn it in Luna, you earn it in PSI, but I was cool earning in PSI then. But this is kind of my backstop. This and the Terra swap is my backstop, so that if I need to manage my loan, right? If Luna starts going down, and if Luna goes down, my LTV starts to look like this, and I've had it go into orange here. When it gets red over here, you're screwed. You're just going to liquid. The orcas of Kujira, Team Kujira, which, by the way, that's a way to buy liquidated, be on the other side of that and buy liquidated Luna at a discount. I made a whole video about that. It's going to be in the chat, which is pretty cool. So you can take your UST, you don't earn the 19%, but in periods of volatility, you might pick up some Luna at a discount, which is pretty cool. I did, and I have the example in the video. But when my loan to value is going like this, I'm going to start to, before I abandon ship on any of my liquidity pools, I'm going to go ahead and take some of that Luna that I'm just earning 7% and just park that here to try and get it down to a safe level. If that doesn't work, I'm going to get some off the Terra swap. And if that doesn't work, then I'm going to start paring down my UST, my liquidity pools, and I'm just going to repay. I'm not going to park collateral. I'm going to straight up repay some of the loan, right? And if that doesn't work, I may have to go all the way down to small cap pairs and get rid of those, even though I may be doing so at a loss. And if that doesn't work, all I did was repay the UST. I still have all those tokens. And even though they're probably going to be depressed, at that point, I'm going to have to abandon ship on that. And rather, me personally, not financial advice, I'd rather do all of that than sacrifice my precious loan. So that was a ton. What do you think about that?
I'm impressed with the whole thing. I've really learned a lot. You know, I'm going to wet my whistle, I think, here on the Anchor protocol and get started on that. I mean, obviously the stable interest rate, you know, and the principal guarantee, those types of things are, you know, those give me some peace of mind, I guess, getting started. And you know, I think once I start working with that a bit, you know, then I can move on to some of these more, you know, more detailed and protocols, and maybe boost up my yield a bit.
And I think it'll help. Like, I'm hoping more and more protocols are going to do what Nexus is allegedly doing. I just heard that. I hope that's true.
Right. Yeah. Because I don't, you know, I'm not the kind of guy who wants to spend a bunch of time monitoring these things either. Yeah. You know, with a sense of fear that, you know, I'm gonna, you know, get liquidated. So yeah, that would be fantastic. And I anticipate that, you know, as well, being a development and everything, like crypto in general, you know, everything's going to get simpler. You know, we're still in the really early days here.
I don't think we're late. It's not investment advice. Do your own research, but we still early. It's not even on the major on-ramps in the US, the native version. Yeah. And by the way, I have a whole video below about how to get the wrap version on Coinbase and how to unwrap it and do all these things on the Terra Station. But we all gonna make it. And that's why I wanted to make this video for people coming in, just to understand what's possible. Again, there's lots of other resources out there on YouTube, guys that were here way before I was, and doing some amazing things if you love the technical aspects. So let's get into this, and we're all gonna make it together, right?
All right.
Cool, buddy.
Thanks a lot.
Talk to you later.
Hutch.
Yep. See you.